What is an IPO? IPO, or an initial public offer, is a way for a company to raise money from investors for its future projects and get listed to stock exchange. IPO helps company to identify their real value, which is decided by millions of investors once their shares are listed in stock exchanges. IPOs also provide funds for their future growth or paying their previous borrowings. In other words, an initial public offering is when a company issue common stocks or shares to public for the first time in a primary market. A corporate may raise capital in the primary market by way of an initial public offer, rights issue, or private placements. However, we will stick to our discussion to IPOs in this chapter and touch upon other types of issues at later stage of this tutorial. IPOs can be used as both a financing strategy and an exit strategy. In financing strategy, the main purpose of the IPO is to raise fund for future expansion of the company. In an exit strategy, for existing investors, IPO may be used to offload equity holdings to public through an public issue. A company selling common shares is never required to repay the capital to investors. Once a company is listed, it is able to issue additional common shares via secondary offering, thereby again providing itself with a capital for expansion without incurring any debt. This ability to quickly raise large amount of capitals from the market is a key reason many companies seek to go public. There are several other benefits for being a public company, namely supporting and diversifying equity base, enabling cheaper access to capital, building a strong public image and get a wider exposure, attracting and retaining better management and employees through liquid equity participation, facilitating acquisitions, creating multiple financing opportunities, equities, convertible debt, cheaper bank loans, etc. For those who are wondering what is a primary and a secondary market, here comes a quick reference. Primary market is a market where investors can buy shares directly from the issuer company who is willing to raise the capital. Secondary market is a market where stocks are traded after they are initially offered to an investor in primary market and get listed to stock exchange. Secondary market comprises of equity and debt markets. Secondary market is a platform to trade listed equities, while primary market is the way for companies to enter into a secondary market. If you think IPO is the only way company can issue its share to investors, then my friend, you're grossly mistaken. There are 5 different types of issues which we will be discussing in the next video. So stay tuned. And if you believe on creating wealth through stock markets, then do open a Demat account without a further delay. Links to open Demat accounts with leading stockbroking houses is provided in description. You may choose to subscribe to our channel and hit that bell icon to get instant notification of our next video, which is scheduled to get launched soon.